Welcome to the Pro Ticker Deep Dive. Right now, on Wall Street, the absolute smartest institutional algorithms that money can buy are predicting something wild. They're saying the stock market is about to rocket to this unprecedented 8,000 point level by the end of this year.
Yeah, which is just a massive number.
It's huge. And here's the catch for you listening at home. If you look at the prediction markets, where real people are betting their own hard-earned cash, they are pricing in a near zero chance of that actually happening.
Right. It's basically a flat-out rejection of the institutional narrative.
Exactly. I mean, we are looking at a massive, 600-point chasm between what the institutional spreadsheets are saying and the reality of the crowd.
And, it really is one of the most severe structural disconnects we have ever seen. I mean, you have these institutional forecasters literally racing each other to upgrade their target.
Yep, they're completely intoxicated by it.
Intoxicated is the perfect word. They are drunk on this narrative of unprecedented structural growth. But then the market participants who are placing the actual, directional bets, they're signaling intense vulnerability.
And that is exactly what we're going to untangle for you today. Because we're sitting here in mid-2026, the S&P 500 is hovering, comfortably around the 7,100 level.
Which feels safe.
It does. If you just read the headlines, everything looks pristine. But beneath this massive wave of optimism is, it's an incredibly fragile foundation.
Oh, absolutely.
We are dealing with these extreme cross-currents right now, violent geopolitical shocks, crude oil spiking aggressively, and a brand new, entirely unpredictable Federal Reserve chairman.
Yeah, that last one is a massive wild card.
Right. So our mission in this deep dive is to help you navigate this huge contradiction. We really need to separate the genuine, undeniable structural growth from the speculative noise without you getting lost in the panic.
Because that contradiction, right, that is the defining feature of this 2026 market. We are witnessing, honestly, the greatest technological infrastructure build-out in the history of capitalism.
The AI boom.
Exactly.
Yeah.
But it is colliding head-on with the physical constraints of the old world. I mean, the macro environment is inherently hostile to the valuations the market is currently trying to sustain.
Yeah, looking at the market right now, for me, it feels like, it's like watching a high-speed bullet train that is somehow building its own tracks out in front of itself.
While accelerating.
Right. While accelerating. It's thrilling. The engineering is magnificent. The sheer speed is exhilarating. But if even one piece of that macro environment snaps.
Or if one section of track isn't laid down in time.
Exactly. If the foundation shifts even a little, the derailment could be absolutely historic.
The momentum of the train is undeniable, but the terrain itself is completely unstable. And to understand why Wall Street is so willing to just ignore that terrain, we really have to look closely at the math driving this bullishness.
Because it isn't just blind faith.
Yeah, not at all. I mean, the major investment banks that are projecting the S&P 500 to hit between 7,750 and 8,000 this year.
And some are even saying 8,300 by 2027, which is crazy.
Right. Some are incredibly aggressive, but they are basing those targets on actual really aggressive earnings data.
So let's get into the mechanics of that earnings data, because the growth projections they're using are just staggering. The baseline EPS projection, that's earnings per share for the S&P 500 index in 2026, is clustering around $337 to $340.
Which represents a massive 21% year-over-year growth from 2025.
Wait, 21% for the whole index?
Yeah, a 21% aggregate profit growth for the 500 largest companies in the United States. It's an absolute behemoth of a number.
That's historically abnormal, isn't it?
Very. That is the kind of aggressive acceleration you typically only model when an economy is bouncing back from the absolute depths of a severe recession.
Like a post-crash recovery bounce.
Exactly. Not when you are late in an economic cycle with, restrictive monetary policy.
Right. But the spark that ignited this specific wave of upgrades, it was the first quarter of 2026. Because Q1 earnings didn't just meet expectations.
They beat them.
Yeah, by a full 6% across the board. And that basically proved to the institutional analysts that corporate America's profit engine is running incredibly hot.
But, and this is the crucial part, when we look under the hood of that engine, it is running on one very specific, very expensive fuel source.
The AI infrastructure boom.
Exactly. We are in the middle of a capital expenditure supercycle that honestly dwarfs anything we saw during the dot-com boom, or even the early days of mobile computing.
Which is saying something.
It really is. The hyperscale tech companies, the real giants, are projected to spend a staggering $754 billion on capital expenditures in 2026 alone.
Just in 1 year?
Yeah. That is an 83% increase from what they spent in 2025.
And the projections show that expanding to $905 billion in 2027. So if we roll in the total tech spend, we are looking at an estimated $1.16 trillion being injected into the architecture of artificial intelligence.
It's almost hard to conceptualize.
It is. I want to pause on that $1.16 trillion figure because I think it's so easy for our brains to just gloss over these massive numbers like, oh, another trillion. But this isn't money being spent on software or, theoretical coding. What is this capital actually buying in the physical world?
That is the right question.
Yeah.
Because it is buying the physical instantiation of a digital future. That $1.16 trillion is flowing directly into land acquisition for gigawatt data centers.
Gigawatt, like actual power plant levels of energy.
Yes. And it is buying thousands of miles of specialized fiber optic cabling. It's buying advanced liquid cooling systems, which are required because, well, the thermal density of these new semiconductor clusters is so high, they would literally melt traditional server racks.
Wow. So they can't even use normal air cooling anymore.
No, air cooling doesn't cut it. And then it's flowing into power grid transformers, which currently have wait times stretching into the years.
Years, just to get a transformer.
Yeah, the supply chain is that backed up. And of course, it is flowing into the semiconductor fabrication plants necessary to build the silicon itself. So the market is looking at this physical manifestation of capital and basically assuming the financial returns are inevitable.
Which brings us right to the valuation math. Because the market is fully pricing in that inevitability, aren't they?
Oh, completely.
Right now, the S&P is trading at a historically elevated 23x to 21x forward earnings. Now, historically, the index averages around, 16x or 17x?
Yeah, right around there.
So investors are paying a massive premium. But at a 23x forward multiple, your margin for error is mathematically zero, isn't it?
Completely zero. You are priced for perfection. A 23x multiple means the market has already aggressively discounted years of flawless execution into today's price.
So there's no room for a slip-up.
None. The market is entirely relying on these hyperscale tech companies, taking that $1.16 trillion investment in physical data centers and translating it into recurring, tangible software profits.
And not just their own profits, right?
Right, they need to generate systemic productivity boosts across the broader economy.
Yeah, because the models estimate that AI adoption will provide a 0.4% boost to overall S&P EPS this year, and then accelerate to a 1.5% boost to earnings next year, purely through, corporate efficiency and productivity gains.
That's the theory, yes.
But I have to push back here, because I hear 21% earnings growth. I hear $1.16 trillion in tech spend. And I see the 23x multiple, but what happens to the other 490 companies in the S&P 500 that are not building AI data centers?
Ah, the rest of the index.
Yeah. Are they just getting dragged up artificially by the sheer gravitational pull of these tech giants? I mean, it feels like we are pricing the entire American economy as if every single company is a hyperscaler.
And that right there is the structural vulnerability keeping institutional risk managers on edge at night. You have a massive concentration of earnings growth at the very top.
The top 5 or 6 names.
Exactly. The 5 or 6 largest hyperscalers are doing all the heavy lifting.
Yeah.
They are generating the actual cash flow to justify their own multiples. But because the S&P 500 is market cap weighted, the entire index's valuation multiple is being pulled higher.
So the rising tide is lifting ships that maybe have holes in them?
Well, think about it this way. If that projected 0.4% efficiency boost doesn't immediately materialize for the old economy companies, the consumer staples, the industrials, the traditional retailers, their artificially high stock prices are suddenly going to look mathematically insupportable.
Because they haven't actually improved their businesses yet.
Right. They're enjoying a valuation halo effect that they haven't inherently earned.
Which perfectly explains the 600-point chasm I mentioned at the top of the deep dive. Because if the math for 8,000 looks entirely justified to the institutional banks writing these reports, the wisdom of the crowds is outright rejecting it.
Yeah, the crowd is not buying the halo effect.
Not at all. When you look at the prediction markets platforms like Kalshi, where participants put actual capital on the line against specific binary outcomes, the disconnect is jarring.
Prediction markets are aggressively fading the institutional consensus right now.
And for those who don't know, what does fading mean in this context?
It means they're betting against it. While the big banks are targeting that 7,800 to 8,000 range, the prediction markets are pricing the S&P 500 to essentially drift sideways. They expect it to end the year trapped in a really narrow 7,200 to 7,400 zone.
And the specific betting mechanics on this are fascinating because they reveal exactly how skeptical the crowd really is. On Kalshi, you can buy a contract that pays out $1 if a specific event happens.
Right, it's a binary. It happens or it doesn't.
Exactly. And right now, the contract for the S&P 500 to just touch 7,800 at any point in 2026, I mean, not even finish the year there, just tap the line for a single second, and Retreat is trading at only 37.5 cents.
Which means the market is assigning roughly a 37.5% probability to the index, even briefly brushing against the investment bank's base case target.
Which is the baseline expectation.
Exactly. And the contract to touch 8,000 is trading at a mere 27.7 cents. The participants in these prediction markets are looking at the 23x multiple and the concentration risk, and they are overwhelmingly voting that the upside is capped.
And it's not just retail traders on Kalshi who are skeptical either. We're actually seeing some major institutional outliers break away from the bullish herd.
Yes, the bears are starting to vocalize their models.
Right. They're forecasting a target as low as 7,100 to 7,000. And they are explicitly warning of a severe summer correction driven by weakening market breadth.
And breadth is the critical metric here.
Define breadth for us.
It refers to participation. If the overall index is going up, but the advance is entirely driven by 10 massive tech stocks, while the other 490 stocks are flat or declining, you have incredibly weak breadth.
The foundation is narrow.
Dangerously narrow. These bearish outliers are looking at that narrow participation and warning that the structure simply cannot support the weight of the index if any macroeconomic shock hits the system.
I am really trying to reconcile this. Are the investment banks just blindly plugging numbers into broken spreadsheets, or are the prediction markets just being overly dramatic? I mean, why does a 600-point gap exist between two groups of highly intelligent people looking at the exact same economic data?
It fundamentally comes down to what each mechanism is designed to measure. Institutional models are designed to measure the endpoint.
Okay, the destination.
Right. An equity analyst looks at projected 12-month earnings, applies a historical multiple, and plots a dot on a chart for December 31st. They inherently smooth over the volatility in between, but prediction markets, however, measure the path.
The path, it's like the Doppler radar versus the National Climate Report.
That's a great way to put it.
Yeah, like the national news might promise a generally sunny, warm climate for the year based on historical averages and broad trends, but your local weather app is looking at the immediate radar and screaming that a severe localized storm is about to hit your exact zip code in 20 minutes.
And if you get caught in that storm, the fact that the annual average temperature is 72 degrees doesn't keep you dry.
Exactly. The institutional targets are the long-term climate report. The prediction markets are the Doppler radar. Traders in prediction markets are heavily factoring in the immediate visceral macro risks.
Because they know that to reach an endpoint of 8,000, the market has to survive the next 6 months without structurally breaking.
They have to survive the storm.
Right. They are pricing in the immediate hazards that an analyst's 12-month spreadsheet assumes will eventually just average out. And right now, that Doppler radar is showing a massive storm cell forming right over the global supply chain.
Because this virtual utopia of AI that we just talked about is running headfirst into a very old-world physical bottleneck. I mean, the prediction markets aren't just looking at stock valuations, they're looking at the physical map of the world.
Geopolitics.
Yes. The geopolitical situation has deteriorated rapidly, and it's centered squarely around the Iran conflict, which has led to the effective closure of the Strait of Hormuz to most commercial traffic.
And the Strait of Hormuz is arguably the single most critical logistical choke point in the global physical economy.
Just geographically, it's so narrow, but so vital.
Exactly. A massive percentage of the world's daily crude oil consumption relies on that narrow waterway. When you choke off that supply route, the physics of the global energy market break down instantly.
And we saw that. The market reaction was violent. Brent crude oil spiked dramatically, jumping roughly 23% in just 12 days.
In less than 2 weeks.
Yeah. It hit an intraday high of $108 per barrel before eventually settling around the $110 mark. I mean, a 23% energy shock in under 2 weeks is the kind of massive input disruption that just shatters economic models.
Because the disruption cascades through the entire system. Crude oil isn't just gas in your car. It is the baseline input cost for the physical economy.
It's in everything.
Everything. It dictates the cost of industrial manufacturing, global maritime shipping, aviation, agriculture, all of it. So that sudden 23% spike immediately manifested in the inflation data.
Which we just got. Looking at the March 2026 data, the Consumer Price Index CPI reaccelerated to 3.3% year over year.
Which was a significant jarring jump from 2.4% in February.
Almost a full percentage point jump in 1 month. And the underlying data shows that gasoline alone drove 3/4 of that entire inflation print.
And this is the exact scenario the prediction markets are pricing in. The Strait of Hormuz bottleneck directly translates into sticky, persistent inflation. And the bear case models currently circulating on Wall Street are trying to quantify what happens if the geopolitical situation degrades further.
What's the pain point they're looking at?
The critical threshold they're modeling is $130 per barrel. If crude breaches $130, the domino effect becomes systemic and threatens to entirely unravel the AI bull case.
Okay, wait. I'm struggling to see how oil at $130 actually breaks a tech-driven market rally. Like, if Microsoft or Amazon are aggressively building data centers to train language models, why do they care what it costs a consumer to fill up a Ford F-150?
It's a fair question.
Is this just about consumer discretionary spending drawing up, or is there a direct mathematical link that drags down tech valuations?
Oh, it is a direct mathematical link. And it operates through two distinct channels. The first channel is margin compression. A sustained $130 oil price acts as a massive, unavoidable tax on the global consumer.
Because they have to buy gas to get to work.
Exactly. When it costs an extra $30 or $40 to fill up a gas tank, that is discretionary capital completely removed from the economy. Consumer spending drops, which instantly pressures corporate profit margins across the retail, travel, and services sectors.
So they miss their earnings targets.
Right. That 21% aggregate EPS growth expectation we discussed earlier, it vanishes. Analysts project a $130 oil shock could cut aggregate S&P earnings estimates by 5 to 8%.
Wow. So the earnings portion of the equation drops significantly. But what about the multiple? We were talking about that 23x valuation. How does oil break the multiple?
That is the second and honestly far more destructive channel. High, sticky inflation, driven by a $130 oil shock, forces the Federal Reserve to maintain high interest rates.
Higher for longer.
Exactly. And when interest rates are high, the risk-free rate of return, which is what you can earn just by holding safe government bonds, remains elevated.
Right.
In any discounted cash flow model, the risk-free rate acts as financial gravity. If an investor can get a guaranteed 5% yield from a treasury bill, they are mathematically unwilling to pay a massive 23x multiple for the distant future cash flows of a tech company.
Because why take the risk when you can get a guaranteed 5%?
Exactly. So the models suggest a $130 oil scenario could violently compress market multiples by 1 to 2 full turns, dragging the market down to a 21x or even 20x multiple.
So it's a double whammy. When you combine falling earnings estimates with a violently compressing valuation multiple, you get a severe structural market correction.
It feeds on itself.
Yeah. The bear case models project that this specific combination could trigger a massive drop down to the 5,900 level.
Which is terrifying for anyone heavily long right now.
That would be a rapid 15% to 21% drop from where we are sitting right now. It would entirely wipe out the AI optimism. And for you listening, you feel this every time you fill up your car. This isn't abstract Wall Street math.
No, it's highly tangible.
How long until that visceral consumer pain at the pump officially forces the Federal Reserve into an unwinnable position?
It is the ultimate nightmare scenario for a central bank. High oil creates a stagflationary environment.
Which means?
It means sticky inflation combined with killing consumer demand. The Fed cannot cut interest rates to stimulate the slowing economy because the inflation data is running too hot. They are pinned in an unenviable corner.
Damned if they do, damned if they don't.
Exactly. And to make this deeply complex scenario even more volatile, the referee managing this entire high-stakes game has just been replaced.
Yeah, let's talk about that, because the timing of this leadership transition at the Federal Reserve is historically staggering.
Yeah.
On May 22, 2026, Kevin Warsh was sworn in as the 17th chair of the Federal Reserve.
Replacing Jerome Powell.
Right. And impartially speaking, just looking at the strict sequence of events, this transition followed a federal investigation into Powell led by a U.S. attorney.
Yes.
And it was accompanied by intense, highly public political maneuvering in Washington.
The political environment surrounding the central bank is heavily fractured right now. I mean, to fully grasp the tension of this transition, you really only have to look at the confirmation vote.
It was close.
Very close. Kevin Warsh was confirmed by the Senate in a historically narrow 54 to 45 vote.
Wow.
Yeah, that kind of razor-thin margin for a Federal Reserve chair is highly unusual, and it immediately injects an element of political scrutiny into every single policy decision he makes.
So who is Kevin Warsh? And what is the framework he is bringing to the table? Because he is stepping into a generational economic minefield.
He brings a formidable and highly practical resume. He's a graduate of Stanford and Harvard Law, but his defining experience really comes from his time as a mergers and acquisitions executive at Morgan Stanley.
So he's an M&A guy.
Yes, he has deep practical roots in Wall Street deal-making. He understands how corporate capital actually flows, rather than just how it operates in academic models.
He's not just an academic sitting in an ivory tower.
Exactly. And most importantly, he served as a Federal Reserve governor during the 2008 financial crisis.
Oh, wow. So he was in the room.
He was inside the central bank while the global banking system was collapsing. He inherently understands the mechanics of systemic risk and shadow banking panics.
Well, his first major test is arriving immediately, because the June 16th to 17th FOMC meeting is his very first as chair.
Talk about a trial by fire.
Seriously. And going into that meeting, the market widely expects the Fed to hold interest rates steady at their current restrictive level of 3.50% to 3.75% for the remainder of the year.
Primarily due to that sticky 3.3% inflation print we talked about, driven by the oil shock.
Right. But holding rates steady doesn't mean the environment is static. Warsh is bringing a radically different communication style to the Fed that is fundamentally going to change how Wall Street operates.
Warsh is engineering a complete paradigm shift in central bank communication. Under the previous regime, the market had grown highly dependent on heavy forward guidance.
Which is what, exactly?
It's a Federal Reserve essentially holding the market's hand and telegraphing exactly what it planned to do with interest rates months in advance.
Like giving them a roadmap.
Exactly. But Warsh views that as a structural flaw. He plans to scale back forward guidance dramatically.
And the most symbolic casualty of this new era is the complete elimination of the dot plot.
Yes, the infamous dot plot.
For years, the dot plot has been the ultimate cheat sheet for Wall Street, right? It's a chart published by the Fed showing exactly where every individual committee member expects future interest rates to go. Why is Warsh so determined to kill it?
Because he believes the dot plot traps the central bank. When you publish a projected path for interest rates, the market prices it in instantly as a promise.
And the market holds them to that promise.
Exactly. When real-world economic data inevitably deviates from those projections, the Fed is forced to either break its promise and shock the market or stick to a flawed path just to maintain credibility.
Neither of which is good.
Right. Warsh prefers the approach utilized by Alan Greenspan. He wants to let actual incoming economic data drive policy decisions in real time, meeting by meeting, without feeling obligated to forecast those decisions months in advance.
It's like Wall Street has been driving a modern luxury car with lane assist and adaptive cruise control for the last decade. You know, that's the forward guidance.
I like that analogy.
Thanks. And Warsh is essentially putting them behind the wheel of a 1960s manual transmission and telling them to feel the road.
Good luck.
Right. They don't just have to navigate the macro environment anymore. They actually have to remember how to drive based on real-time feedback. Taking away the dot plot feels like taking away Wall Street's behavioral security blanket exactly as a massive inflation storm is hitting.
And the behavioral finance impact of removing forward guidance really cannot be overstated. The market inherently hates uncertainty far more than it hates bad news.
Because bad news can be priced in, uncertainty can't.
Exactly. When you remove the dot plot, you instantly elevate baseline market volatility. Every single economic data print, every inflation report, every localized jobs number suddenly becomes a high-stakes guessing game for how Warsh will react at the next meeting.
There's another incredibly fascinating layer to Warsh's economic philosophy, though, that ties directly back to our AI discussion from earlier. He actually has a specific theory on how artificial intelligence alters the inflation equation.
Yes, he does. Warsh has publicly explored the theory that the massive productivity gains expected from the AI infrastructure build-out might structurally alter the economy's capacity to sustain lower interest rates without sparking inflation.
So AI is a deflationary force.
Precisely. The economic theory is that if AI allows companies to become drastically more efficient, it structurally lowers their operating costs.
Right.
This acts as a powerful deflationary force across the economy, potentially giving the Federal Reserve the breathing room to eventually lower rates, even if consumer demand remains relatively strong.
But we aren't in that deflationary AI utopia yet.
No, we're very much in the messy transition phase.
Right now, rates are restricted at 3.50 to 3.75%, inflation is up at 3.3%, and oil is a constant threat. If the data forces Warsh to actually hike rates instead of just holding them steady, there is a historical precedent that analysts are deeply worried about.
The historical data regarding central bank pivots is highly concerning right now. Analysts are circulating a study looking at the market impact when the Federal Reserve reverses an easing cycle.
Meaning they stop cutting rates.
Right, and unexpectedly resumes rate hikes. The history shows that when the Fed resumes rate hikes under these conditions, the S&P 500 typically suffers a rapid, low single-digit pullback in the weeks immediately following that first unexpected hike.
It's like a shock to the system.
Yes, the market experiences a physiological negative reaction to the sudden, unexpected tightening of liquidity. If inflation forces Warsh's hand, the market will punish that decision instantly.
So let's pull all of these incredibly complex threads together. We have the unstoppable force of $1 trillion AI capital expenditure boom pushing the market toward 8,000.
A bullet train.
The bullet train. But we have the immovable object of $110 oil, a closed Strait of Hormuz, and 3.3% inflation dragging it down.
Broken tracks.
Yes, and we have a new Federal Reserve chairman who has thrown the GPS out the window and is flying by the instruments. Given all of this conflicting data, how should a portfolio actually be positioned to survive?
In an environment defined by extreme crosscurrents like this, portfolio construction shifts away from aggressive growth hunting and focuses heavily on survival.
And tactical sector rotation, I imagine.
Exactly. You have to thread the needle between participating in the AI upside and defending against the macro volatility.
So where are the institutional analysts saying we should be overweight right now?
The first mandatory overweight sector is TMT tech, media, and telecom.
Even with the 23x multiple?
Yes, because despite the zero margin for error valuations, you simply cannot bet against the sheer physical volume of capital flowing into the AI build-out. The momentum of that $1.16 trillion spend is a structural reality.
It's happening whether we like it or not.
Right, and it will generate massive revenue for the primary infrastructure providers, regardless of what the broader economy does.
Okay, what's next?
The second overweight sector is industrials, which makes perfect sense when you look at the physical requirements of that build-out.
Right, because someone has to actually build the physical data centers?
Exactly. Industrials are enjoying a massive dual mandate right now. You have a broad national push for domestic manufacturing and supply chain reshoring, combined with the intense physical construction required for those gigawatt AI data centers.
The concrete, the steel.
Somebody has to manufacture the steel frames, the specialized HVAC systems, and the advanced cooling towers we talked about earlier.
Which leads perfectly to the third overweight sector, utilities. I find this one absolutely fascinating because historically, utilities are the most boring, defensive, low-growth sector in the entire market.
They are the classic widows and orphans stocks.
Exactly. You buy them for the dividend and forget about them.
But the narrative around utilities has fundamentally broken from historical precedent. Utilities are suddenly trading as a high-growth play.
Because of the AI power demand.
Yes, because of power density. AI data centers consume unprecedented, astronomical amounts of electricity. A single facility can require the energy equivalent of a mid-sized city.
That is insane.
It is. The power demands of this new infrastructure are forcing a total reevaluation of the utility sector's long-term growth potential and pricing power. They are the essential picks and shovels of the AI gold rush.
Okay, so those are the areas to overweight. TMT, industrials, utilities. Where should we be hiding from? What are the sectors to underweight?
The primary underweight recommendation is consumer discretionary.
Which makes sense based on our oil discussion.
Completely. This is the direct, localized fallout from our oil and inflation deep dive. The cumulative grinding pinch of 3.3% inflation and $110 crude oil is finally exhausting household balance sheets.
People are just tapped out.
They are. Consumers are actively triaging their budgets, cutting back aggressively on non-essential spending, travel, luxury goods, making the discretionary sector highly vulnerable to deep earnings misses.
Now, here is the sector rotation that initially surprised me when I was looking at the data. Financials have been downgraded to neutral.
Ah, yes.
If interest rates are staying higher for longer at 3.50 to 3.75% under Warsh, shouldn't banks and financials be rolling in cash from higher net interest margins? Why are they being downgraded to neutral in a high-rate environment?
To understand the downgrade, you have to look completely outside the traditional, highly regulated commercial banking sector. The systemic risk currently haunting the financial sector is buried in the shadow banking system.
Specifically within private credit, right?
Yes, private credit.
Private credit has exploded into a multi-trillion-dollar asset class over the last decade. Break down the mechanics of what is actually happening there for us.
So private credit involves non-bank institutions, massive private equity firms, and alternative asset managers making direct, bespoke loans to mid-sized and large companies.
Bypassing the traditional banks entirely.
Exactly. For a long time, in a zero-interest rate environment, it was incredibly lucrative because it offered high yields. But, and this is the trap, these loans are highly illiquid.
Meaning you can't just sell them if you need cash.
Right. You cannot simply sell a direct corporate loan on an open exchange the way you can sell a share of Apple stock. Private credit is essentially a roach motel for capital. Money checks in easily, but it is incredibly difficult to get out quickly.
And right now, analysts are tracking severe warnings about rising redemption pressures within these private credit funds, meaning institutional investors like pension funds or endowments are demanding their money back.
Exactly. But because the underlying loans of these mid-market companies are illiquid and locked up for years, meeting those sudden redemption requests creates an immediate, severe liquidity mismatch.
The fund managers are trapped.
They are. Analysts are warning that this dynamic is creating massive systemic vulnerabilities outside the regulatory purview of the traditional banking sector. That opaque, unquantifiable risk is casting a shadow over the entire financial sector ecosystem.
And dragging it down to a neutral rating.
Precisely.
So if you are an investor trying to navigate this minefield, you want the upside of the AI infrastructure boom, but you are terrified of the oil shocks, the private credit liquidity traps, and a Fed chair who refuses to give you forward guidance. What are the specific tactical strategies for defense?
Analysts are heavily recommending two primary layers of structural defense. The first is to rotate aggressively into what they classify as negative beta stocks that possess positive earnings revisions.
Break down the mechanics of negative beta in this specific context.
Sure. Beta is simply a measure of an asset's volatility relative to the broader market. A high beta tech stock swings violently in the same direction as the market index.
So if the market drops 2%, the high beta stock might drop 4%.
Right. But a negative beta stock moves independently, or often inversely, to broader market panic. In this environment, you want companies backed by tangible, physical assets that possess absolute pricing power.
Companies that provide essential goods, where consumer demand is highly inelastic, regardless of what Kevin Warsh decides to do at the next FOMC meeting.
Precisely. Analysts are specifically pointing to names like Coca-Cola, Costco, T-Mobile, and Mondelez.
Staples.
Exactly. These are companies that provide everyday essentials or incredibly sticky subscription services. Crucially, they possess the pricing power to pass the costs of 3.3% inflation directly onto the consumer without destroying their own demand volume. People will still buy groceries and pay their phone bill.
And the second layer of defense?
It is the oldest, most fundamental defense in financial history, maintaining direct exposure to physical commodities and gold.
The ultimate safe haven.
Yes. In a world where a geopolitical flare-up can close the Strait of Hormuz overnight, and where central bank policy is wildly unpredictable, owning hard physical commodities is your ultimate structural inflation hedge.
It protects the baseline purchasing power of your portfolio when fiat currencies and high-growth equity multiples are under extreme pressure.
Exactly. It's an anchor in the storm.
Well, let's bring all these dual realities together as we wrap up. We are currently living through what might be the single greatest technological infrastructure build-out in human history.
Over $1 trillion.
Over $1 trillion being poured into the physical foundation of artificial intelligence, promising an era of unprecedented corporate productivity. But that futuristic digital utopia is violently colliding with the physical constraints of the old world.
We are bottlenecked.
Bottlenecked by Middle East oil choke points, threatened by sticky, persistent inflation, and navigating a monetary landscape where the central bank has torn up the map and turned off the GPS. We are looking at a market priced for absolute perfection, operating in a deeply, inherently imperfect world.
And, if we extrapolate this entire scenario out to its logical conclusion, it leads to a much deeper structural paradox that the market is completely ignoring right now.
What's the paradox?
We are spending over $1 trillion to build this AI infrastructure, largely with the expectation that it is going to massively boost corporate efficiency and drive that 1.5% EPS growth we discussed.
Right. The entire 23x valuation multiple is predicated on that efficiency actually materializing.
But here is the critical foundational question. If this AI infrastructure actually succeeds, if it fully optimizes, automates, and streamlines the corporate workforces that make up the vast majority of the S&P 500, what happens to the baseline consumer demand of those displaced workers?
Oh, because they won't have the income to spend.
Exactly. You are automating the labor force to aggressively boost corporate profit margins,
Yeah.
but that labor force is the American consumer.
So, could the very technology that is currently driving the market toward 8,000 points ultimately erode the foundational consumer base required to actually sustain those record profits?
It's a snake eating its own tail.
Wow. We are building the track so fast, the train might just leave the passengers behind entirely. You, the listener, think about that paradox the next time you look at your portfolio. Are you buying into a generational productivity miracle, or are you essentially investing in the obsolescence of the consumer? Is the defining economic tension of our time. Thank you for joining us on this journey through the crosscurrents. Keep your eyes on the radar, and we'll see you next time.